Picture this: in Niger, a landlocked nation in West Africa, families live without electricity, and nearly half the population faces extreme poverty. Schools, roads, and hospitals rely heavily on international aid to stay functional. Meanwhile, 7,000 kilometers away in Bangladesh, the focus is entirely different. The country, with a booming population and industrial growth, is seeking funds to build renewable energy plants and move away from coal reliance. Two countries, two very different realities, and yet both turn to one institution for help: the World Bank, specifically its International Development Association, IDA, which supports the world's poorest economies. But in 2025, the World Bank faces a tough reality, one that risks leaving nations like Niger and Bangladesh short of critical funding. So, um, challenge one: limited donor contributions. At its heart, the IDA fund operates on a simple model. Money comes from rich donor countries and gets distributed to poorer nations as grants or low interest loans. However, at a recent funding conference in South Korea, the World Bank announced a $100 billion pot for the next 3 years. Sounds impressive, right? Well, there's a catch. Donor contributions have flatlined, staying roughly at 24 billion. Adjusted for inflation, this is the most miserly contribution this century. In other words, while the demand for aid is rising, the actual funds are falling behind. This forces the World Bank to borrow heavily from the market, adding risk and complexity. For countries like Niger, this spells trouble. In the past decade, IDA grants, which don't need to be repaid, tripled in value. Now they're expected to shrink. The maximum grant a country can receive will drop from $1 billion to just 650 million. For governments trying to invest in hospitals, schools, and roads, that's a significant hit. Challenge 2: climate priorities versus development needs. Here's where things get tricky. While the world's poorest countries rely on IDA funding for basic development, richer developing nations are requesting funds for climate related projects, building wind farms, installing solar panels, and tackling carbon emissions. Don't get me wrong, climate finance is important, but critics argue that this focus diverts resources from urgent development priorities like fighting poverty and improving infrastructure. For Niger, a grant to build a road could mean life or death for remote communities. For Bangladesh, attracting foreign investment in green energy is vital for its growth. But with limited resources, how does the World Bank decide who gets what? The World Bank's Tightrope Act. The World Bank's balancing act involves financial gymnastics. To stretch every dollar, they're using creative tools like floating interest rates and hedging services instead of traditional fixed rate loans. They're also borrowing more heavily from global markets. But these solutions come with strings attached, and often at a cost to the poorest nations. Some countries may face an impossible choice: take smaller grants or convert grants into loans. For debt-ridden nations like Niger, this could mean spiraling deeper into fiscal crises. Even countries that benefit from the World Bank's climate shift may find the terms less favorable than before. Opportunities: can growth save the day? Despite the challenges, there are some bright spots. The World Bank hopes that economic growth across the developing world will reduce the need for its support. If countries like Bangladesh succeed in attracting private investments for green energy, they could lift themselves out of poverty faster. But what happens if growth stalls? The reality is that sluggish economies, rising debt, and geopolitical instability continue to plague many IDA countries. In Niger, for example, a series of military coups has disrupted development efforts, making external funding even more critical. The consequences of belt tightening. Let's zoom out to understand what's at stake. Without adequate IDA funding, countries will struggle to invest in essentials. Schools won't get built, hospitals won't receive equipment, roads will remain unfinished, isolating communities. In short, the very foundation for poverty reduction and development could crumble. For the world's poorest nations, there are no other options. Locked out of international markets due to high interest rates and debt risks, they rely on the World Bank's support to survive and thrive. As aid funding shrinks, the most vulnerable countries could pay the highest price. Conclusion: a call for balance and action. So, where does this leave us? The World Bank's struggle to serve all 78 of the world's poorest countries reveals a stark reality. There isn't enough money to go around, and tough choices lie ahead. The question is, can the World Bank balance climate priorities with urgent development needs? Can it stretch its resources without leaving the most vulnerable behind? The stakes are high. The future of millions in countries like Niger depends on roads, schools, and hospitals that can only be built with sustained, generous support. As we move forward, the world must ask itself, are we willing to let the poorest nations bear the cost of our inaction? Podcast close. Ooh. Thank you for tuning in to the Log Finance podcast. If you enjoyed today's discussion, don't forget to subscribe and share this episode with others. Let's keep this conversation going. The future of development depends on it. Until next time, stay informed, stay inspired, and take care.